Yeah, welcome to the Q2 2025 results presentation for Caledonia. Could you just move on to the forward-looking statement and disclaimer, which you will read and digest? Okay, let's move forward to the presenting team. As Scott said, I'm Mark Learmonth, Caledonia's CEO. I'm here in Jersey today, joined by Ross Gerrard, our recently joined CFO. He's in Johannesburg and will run us through the financial results. We've got James Mufara, our Chief Operating Officer, who's joining us today from Blanket Mine. Victor Gapare in France will briefly update us on the Bilboes project. And Craig, Vice President Technical Services based in Johannesburg, will talk to us briefly about the ongoing exploration at Bilboes and Motapa. And Morris, Vice President Corporate Development and Investor Relations, will deal with any other tricky questions that may arise. So should we just move forwards? Okay, well, look, it was a very strong financial quarter underpinned by excellent production. So the financials were strong, revenue up 30% to 65 million, a net profit attributable to shareholders up by 147% to just over 20 million, and adjusted earnings per share was up by 155%. Underpinning that was some very strong operating cash flows. Operating cash flows rose to 28 million, and we closed the quarter with $8 million of net cash. In addition to that, we had another $18 million of fixed-term deposits. So if you regard fixed-term deposits as cash, which I do, that's about $26 million of cash. From an operating perspective, Blanket Mine had an excellent production quarter. Just over 21,000 ounces in the quarter, which is a record for any second quarter. And on the back of that, we've increased full-year guidance to a range of 77,500 to 79,500 ounces. And all of this was really underpinned by a stronger gold price. We realized just under $3,200 an ounce. As you'll be aware, in the quarter, we closed the sale of the solar plant, which realized 22.4 million. I'll be clear, we never intended to own that solar plant. We only had to own it to get it built, and it was always the intention to sell it. Part of the sale is that we've secured a long-term supply contract for Blanket, so we just released the capital for use elsewhere in our core business, which is developing and running gold mines. And as you'll be aware, we've got a very strong growth pipeline. We're continuing at a pace with the Bilboes feasibility study. We're looking at cost-saving options and a phasing approach to try and minimize the upfront capital cost of the project. Victor can update you on that shortly. We've got a $2.8 million exploration program proceeding at Motapa, which is going well. And it's also fair to say that the exploration at Blanket's also going very well. That exploration at Blanket's got two aspects to it. The first is just simply resource replacement. So just making sure that we replace the resources that we're depleting, but also probably with some excitement is new areas within the Blanket lease, which we've never had the money or the management depth to do. And we're now turning our attention to that, and we're getting some quite good results out of that. So just in a bit more detail, just turning on to the next page. James will talk to us about safety and production, but it's pleasing to see an improvement in our safety performance. The total injury frequency rate for the quarter and for the half year has improved. Clearly, there's always further work to do, but it's good to see the general direction of travel is in the right way. James will also talk about production, which I've mentioned. I've mentioned the average gold price. Revenue up from 50 million to 65 for the quarter, up from 88 to 121 million for the half year, and gross profit of 33.8 million for the quarter, which excludes the $8.5 million profit on the sale of solar. So adjusted earnings per share for the quarter were about 114 cents for the quarter. That includes about 44 cents from the profit on the sale of solar. So that equates to about 70 cents from operations, and that compares to approximately 40 cents that we made from operations in the first quarter. So even stripping out the benefit of solar, it's been a very good quarter. Should we just move forwards? And a lot of people, as we look forwards, look at how far we've got to go in terms of climbing the hill to deliver the Bilboes project. It's also worth looking backwards to see how far we've come over the course of the last 10 years. And so all we see here is a a 10-year graph from Bloomberg, which shows the gold price, the VanEck GDXJ index, and our share price, including dividend reinvestments. And it shows you that over that 10-year period, the gold price has gone from 100 to just over 300. The GDXJ has gone up from 100 to just over 400, and Caledonia Mining has gone from 100 to over 1,000. So it's a great performance over the last 10 years. But during that period, all we've done is take Blanket from about sort of 40,000 ounces to 80,000 ounces. The growth trajectory ahead of us is even more exciting. And I think what underpins our performance over the last 10 years is two things. First of all, minimizing dilution. And that is, we say that in terms of funding Bilboes, our objective is to minimize dilution. We really mean it. I mean, we delivered great returns over the last 10 years by keeping a very tight lid on equity dilution. There's no reason why we're going to depart from that now. And the second is the importance of dividends. Now, clearly, we don't have a dividend policy in terms of a dividend payout, but we really understand the importance of dividends in terms of shareholder returns. And in certain markets, particularly Zimbabwe, which is a good source of equity for us and great support, the dividend is crucial there. So the dividend is again baked into our appreciation of how we run this business. Just moving forwards, I think it's also worth making a few comments about Zimbabwe. Look, we operate in Zimbabwe every day, and when you're so close to the coalface, it's sometimes quite difficult to step back and appreciate what's been going on there. And frankly, over the last 5 years or so, we really have seen some very encouraging signs in Zimbabwe. Physical security, which has never really been an issue in Zimbabwe, remains, but it's become much more of a serious issue in other jurisdictions in Africa. And it's just worth noting that whilst many other places have got worse, Zimbabwe hasn't got worse, and in some respects are getting better. Foreign exchange, the foreign exchange environment in Zim has historically been super turbulent. What we've seen over the last 18 months or so is an increased stability and further moves to liberalize the local market, the local foreign exchange market. Clearly, there's further work to do, but we are seeing increased liquidity for selling the local currency, the ZiG, in the willing buyer, willing seller market, which is good. And we're also seeing more stability in the ZiG dollar exchange rate, which is underpinned by continued financial rectitude on the behalf of the Reserve Bank of Zimbabwe. So long may that continue. We wouldn't have achieved the results we have done without a high quality local workforce. And one of the things that's happened behind the scenes over the course of the last year or so is that we've substantially changed our management team, relocating people or taking people on in Zimbabwe. And we wouldn't have achieved the record production that we did in the second quarter after a very creditable first quarter without high quality local management. And so it goes without saying that that the management team in Zimbabwe really has got experience, they've got quality, and about 50% of the current senior management team at Blanket, about the top 25 senior managers, of those top 25, about half of them have been with us for a year or less. Clearly, there's an electricity problem in Zimbabwe. It produces less electricity than it needs, but the government over the course of the last few years has taken several initiatives to try and ameliorate that situation for people like the big users like Caledonia, or Blanket. We're a member of what's called the Intensive Energy User Group, which means that we can import power from the South African power pool or the Southern African power pool, where there was no shortage of power availability, so we can actually import that. And it's also fair to point out that the Zimbabwean authorities have been very quick to fast track the permitting for independent power projects, be they solar or standalone coal-fired power stations. I think all of that's reflected in Zimbabwe's ranking in the Fraser Institute survey, which was published recently. And that showed that Zimbabwe's come up from the absolute bottom of the table, and it now ranks 8th out of the 17 African countries which are covered by the survey. So we are seeing encouraging signs in Zimbabwe, and we hope that those signs that progress continues. So with those introductory comments, I'll hand over now to Ross, who will run us through the financials. So Ross, over to you.
Thank you, Mark, and good afternoon, everyone. It's my absolute pleasure to talk you through the financial results for this quarter, and reiterating what Mark said, it was another excellent quarter. So if we can turn to the next slide, please. just talking through some of the headline numbers that were referred to. Gold revenue was up at 65.3 million, which was up some 30% on the comparative quarter. This was driven by that good gold production, up at 21,000 ounces, in addition to the benefit of a really good realized gold price of $3,186 per ounce, which was up some 38% on the comparative quarter of 2024. This obviously meant that there was a higher royalty during the period that you'll see on the right-hand side of the table. And importantly, the delivery of those ounces, which was really driven by higher grades and plant recoveries, and James will talk to those a little bit later in the presentation, but that did drive our production costs, which were up some 18% for the quarter. We will do a bit of a deeper dive into those production costs in a moment, but the end result at a high level was that gross profit number of $33.8 million for the quarter, which was up 48% and another quarterly record. So a fantastic result. If we turn to the next slide, we'll just talk about that gross profit. I love the slide, and it's a very simple slide with a great trajectory, but the two key messages to take away is the change in Bilboes and the fact that it's no longer having a negative impact. So that's indicated by the orange line. And importantly, the trajectory of Blanket, where you see that significant increase in profit, all heading on in the right direction, and I guess we've got to keep that trajectory going. So really great delivery across the year and looking forward in terms of a gross profit profile. But if we turn to the next slide, we'll do a bit more deeper dive into those costs. And you'll remember from the first quarter result where we spoke around our guidance, where we're sitting from a cost perspective slightly above our guidance range. You can see on the left-hand side, we're now bringing that back within range, albeit still at the top end of the range. So costs are very much still part of our focus, and we've got a number of key initiatives that we've got in play that will address that. And overall, we believe that the full year guidance range is still on track and will be achieved. But you'll see that the three key pillars of our cost base in terms of labor, consumables, and power are indicated in those slides. I guess from a labor perspective, the key changes are really around the payments of higher production bonuses. A key component of that labor cost was a almost $2 million cost that went through in terms of bonuses, overtime, and holiday pay, is really around delivering those tons, but also addressing certain breakdowns during the period that we had to address, and well done to the team to get on top of that. Consumables was really above budget by around $3 million. And a large portion of that was around those ZiG purchases, where we've spoken about mobilization of ZiG purchasing items like lime, mill balls, some construction materials. So there was about $1 million that we spent in terms of accessing the willing buyer, willing seller market there, but also some overruns in terms of spend in terms of our TMMs and also some of the engineering and repairs and maintenance and electrical engineering works that sat within that consumables bucket. This was partially offset by the power savings that you see in the lighter blue column there. And again, credit to the team. This is a key initiative that we've articulated very clearly in terms of having a stated objective or a project in terms of addressing a certain area. And you can see the benefits of some of those power savings coming through. Well done again in terms of a key delivery. Moving to the right in terms of what it means for all-in sustaining CapEx. The on-mine costs that we've just spoken about, they've flow through. So you'll see a 7.4% increase in terms of comparative quarter there. But the big bucket was that sustaining CapEx bucket. And again, that CapEx spend is on track for our full year guidance. Traditionally, our second and third quarter are bigger quarters in terms of spending from a CapEx profile perspective. It's probably fair to say that the previous quarter, in terms of comparing to this time last year, was probably on the lower side, just because of funding constraints. But I guess the overarching message here is our CapEx profile is on track. We're spending it in the right buckets, and we believe that full year guidance profile will be met. So great performance in terms of our individual cost profiles. And if we move to the next slide, we'll look at some of those costs below the gross profit line. That net foreign exchange loss line item, that's obviously a big area of constant focus for us. We are managing to deploy our ZiG balances, and a key position in that is being able to access that willing buyer, willing seller market. That run rate is lower than the comparative quarter. You'll see that that's dropped, and that is a combination of both realized and unrealized losses. So it's about a 1/3, 2/3 split in terms of the full 6-month period. But we're pleasantly pleased with the result in terms of where we sit for the half year, but it is an area of constant focus in terms of deployment and managing our exchange risks. The corporate line item that you see there, a lot of that includes some one-off costs in terms of restructuring that Mark had alluded to, that has come through in that first half, but also some additional equity share-based payments expenses that have come through, and that's just based on the metrics and the performance to date. The big items are the sale of the solar and the profit coming through. So you'll see 8.5 million as an individual line item coming through, and then equally down at the tax expense line, the good performance, the good revenues and activity that's occurred has obviously resulted in a higher tax expense. But we've also included the tax on the solar sale in that line item. And whilst that number has increased, I think it's very important that, paying our way and paying taxes is very important. So it's a pleasing result in terms of good performance, and actually across both royalties, taxes paid, and tariffs, we're certainly a major contributor in terms of Zimbabwean economy and paying our government share, our fair share to government. So it's a pleasing result. But overall, a great performance, ending with a profit for the period of $23.6 million. And you'll see the earnings per share there of 113.9 cents per share. And adjusting for the solar, as Mark had indicated, you'd back out approximately 44 cents from that. So comparing just shy of 45 cents for the comparative quarter against 70 cents for this quarter. It's a great step up in terms of performance. So if we can move to the next slide, we'll talk a little bit more about the cash flow. Our cash flow from operations is, we've really done well. We've generated some strong cash. There has been the net increase in the working capital. There's been that deliberate increase in working capital, particularly around stores and prepayments, where we've deployed and tried to use our ZiG balances and have local purchases. There are some changes in that net line in terms of timings of shipments of payments and receipts, but overall, there's a deliberate position in terms of working capital to make sure that we can be robust with our operations. But the key areas that I want to speak about are our capital expenditure. So you'll see, from that operating activities or cash generation, we've been able to deploy our funds across investing in our capital expenditure. So some almost 21 million for the 6 months in terms of capital expenditure. We've received proceeds from our sale of our solar of 22 million, and equally we've been able to deploy those funds into fixed term deposits and some derivatives. So it's been a very solid quarter, and in fact 6 months in terms of both generating cash and closing the period with some $8.2 million of cash, with that further 18 million sitting in terms of deposits. So effectively a $26.2 million cash balance. So if we move to the next slide, you'll see the breakdown of that 26.2 million on the right-hand side of the slide, both in terms of where that cash sits across the various jurisdictions, but importantly, the build across the comparative periods in terms of our trajectory in terms of treasury and cash. I would highlight that the balance, the 4 million sitting in Zimbabwe, that's abnormally high. It was really around timing and deployment of funds. So it was really timing of that. But overall, the 26 million, and actually, if you exclude the overdraft facilities, so on a gross basis, we actually just shy of 40 million in terms of cash balances. And post the half-year result, we've been able to continue to build that 26 million up to 30 million in terms of our pro forma net cash position on basically this last week's cash balance position. The graph there shows that build-up of cash, so it's very important. And I think the key thing, or key takeaway, is that we're trying to build that cash balance to a $50 million plus number by the end of the year in terms of really having a solid treasury position. We move to the next slide. The one thing that we would like to highlight, and you'll see in the published results, is that we will be taking advantage of some applicable exemptions. So in terms of our quarterly reporting, we'll be following a reduced disclosure regime or reporting disclosure. So for both the first quarter and third quarter going forward, we will have a much reduced financial, both MD&A and financial set of results coming out. We are fully committed to our transparent and timely disclosure, so we'll give you all the material information and select financial results coming through, but you won't see the full set of MD&A financials that you've historically seen. That is only for first and third quarter. For the full year and obviously half year, it'll be part of the normal cadence, and you'll get the full deep dive and narrative that's going forward. So with that, a very solid quarter and half year, and I think we're well set to enter the second half of the year and deliver on continued good performance. And with that, I'll hand over to James Mufara, our COO.
Thank you very much, Rose. Thank you very much, Mark, for the opening remarks as well. Good afternoon to you all. If we can move to the next slide. As Mark and Rose have already alluded to, we have had a very good and solid half year, and this quarter was particularly very good. We brought to the market earlier that we had a very, very stringent look at our health and safety programs on the mine as part of our value of care. And we've always said we would want to improve in terms of our performance thereof. Quarter two delivered a marked improvement from quarter one in terms of our health and safety criteria that we're looking at. The number of accident-free days actually increased in the quarter from 83 to 85. And the total injuries themselves actually reduced. The lost time injuries went down as well from 4 to 1. And the significance of the lost time is showing the severity of the accidents that we are having. They are of low energy accidents that we're actually having and witnessing. In the quarter, we also had quite a number of bow ties that we actually completed so that we could look at all the significant and wanted events that we want to deal with, and 52 of them were actually completed in the quarter. As part of our culture journey to see that employees work safer and better with time at Blanket Mine, we started to profile our employees for risk propensity, which is their propensity to take risks, and we started with the supervisors, and we will look at this journey going forward so as to look at continuing to improve health and safety. But as we would appreciate, health and safety is like sweeping water uphill. You need to be constantly at it. If you stop, it will come back to you. So keep obviously our eyes open with regards to health and safety issues. If you may go to the next slide, please. So in terms of the grade and the tons, which is our traditional reporting line, you would see that the orange line is the grade, and the blue, the top line, the dark blue line represents the tonnage. We're pleased to report that we had a record production in terms of tons that were milled. We actually ended up on 204,915 tons for the quarter, against a plan of 193,000, which is actually 6%, 11,000 tons or 6% above what we set as the plan. We also realized that in this quarter, we actually had a welcome improvement in the grade from the last quarter, ending up above plan at 3.31 grams per ton, representing a 3% better than the plan. This was a welcome, improvement, and it's a result of our continued focus on the increase in flexibility and our look at the development that we've been increasing over the years. In terms of the bottom graph, which actually represents the ounces and the recovery, you will see that we produced the record ounces that Mark alluded to, which is a record production for any second quarter. And that was underpinned by, a record recovery of 94.41%. We've actually managed to get to this number by 3 key initiatives that we actually introduced in the quarter. And the first one was the introduction of tank number 9 to optimize the residence time so that we could actually recover better. The second one was to look at reagent dosage and optimize that so that we could have efficient leaching and efficient adsorption. We also started to have enhanced process control through short interval controls with the new management team that we've actually put at the plant. All these initiatives resulted in a record Q2 production in terms of ounces, as alluded by Mark earlier. If you may turn to the next graph, please. So this graph shows how we actually achieved the ounces, that this was not a once-off haul. This was not that we did right at the end of the quarter. It was we produced consistently throughout the quarter, feeding the plant with consistent grade and consistent tons, and thereby producing the record production. You can see that the top line, the orange line, is the cumulative, the adjusting, what we actually did, and the bottom line, or the line which is deeper, purple, is actually the line for the budget. You can see that from the first month, which is the April month, we actually, while we had a budget of 5,818 ounces, we already superseded that. We continued at a steady rate throughout the whole quarter, ending up on 21,070 ounces. This supersedes the Q2 ounces for last year, which were sitting on 20,774 ounces, and also better than the same Q2 ounces for 2023, which were sitting on 70,400 ounces. So this is really, really a record production, and done the right way consistently throughout the quarter. We may turn to the next graph, please. So this is a very nice graph, which actually points out to how well the team is doing all around. So it's, while the team has actually achieved record production ounces, they have also done it in a very responsible way. You can see that in terms of reserve generation, we actually added reserves in terms of the reserves that we actually generated. This is as a result of better development, which was done by the team. I mean, thanks to Elton and Newton for doing this massive development, being over their development targets over the quarter. And this is as a result, actually, us putting back some reserves back into the iceberg. If we may go to the next graph, please. Thank you. I will hand over to Victor.
Thank you. Thank you, James. Thank you, Mark. Can we move to the next slide, please? What we would like to do today is to update you on where we are with the Bilboes feasibility study. The work on the Bilboes feasibility study is continuing at a very satisfactory pace. The work has confirmed that the project has robust economics with a high debt capacity. The main areas which we have been evaluating include consideration of moving the tailing storage facility to the Motapa property, which is just next door to the Bilboes property. Really, the benefit of this would be lower construction costs because of the topography. Whereas at Bilboes, it's rather a flat piece of land where we would need to put the tailings facility. At Motapa will benefit from the topography, so it will reduce the earthworks which we have to do there. The other consideration which we have been looking at is really looking at a phased approach to the project, starting at a smaller level, at a smaller scale level, and then ramping up to full capacity. This really looks at the issues of financial prudence at the end of the day, just to make sure the amount of capital we are raising is not excessive. We've also been exploring short-term revenue opportunities across our asset portfolio. This would actually help in terms of the financing of the project.
Yeah, so as Victor was saying, in terms of funding, our aims, we've said this before, but we mean it, is to maximize net present value per share, and that is balancing growth and minimizing equity dilution. And that's why I started off with that graph, which shows the extent to which we've outperformed the GDXJ. That's largely because we've not diluted shareholders, and that's in our DNA. So Victor said that the reason we're looking for a smaller scale phased approach is to minimize the amount of debt we take on, and hopefully to avoid completely any equity dilution, but with a prudent level of gearing. So in terms of the funding options we're looking at, the non-equity funding options, we're looking at non-recourse project finance, and there's a handful of African development finance funders who've expressed interest. We're looking at a modest amount of mezzanine funding on the basis that it is substantially cheaper than our cost of equity, and also asset-backed loans. So the final funding decision will clearly follow the feasibility study and will depend on funder timelines. Some of these funders may not be quick, but we'll do the best we can. So I think that's probably the best update I can give on Bilboes.
I'll hand over to Craig, who will take us through the Motapa exploration.
Thank you, Victor. Thank you, everybody. Good afternoon. Just while we're on the slide, I just want to touch briefly on Blanket for people that are not aware. On the 23rd of June, we published a Blanket deep drilling press release. So that's why there's not much about Blanket actually in here. Continue with our deep drilling program. We continue to get expected grades, in some cases much better. Carrying on with the widths and the whole intention is to maintain our resource base at kind of the 3 million ounces, which delivers a mining reserve plan of about 10 years. So that's kind of what that drilling is focused on. The CEO alluded to the fact that we're also looking at other opportunities. I haven't got results to share with anybody, but one thing that I want to leave in people's minds is that if you visit the Blanket property, the one thing that you won't see at Blanket is an open pit. If you go visit a number of other mining properties in Zimbabwe, well, guess what? They all started off with open pits and progressed underground. So if we can go on to Motapa, if we can go to the next slide. A reminder of what we are doing for the year. So we have a $2.8 million budget for the year. It's mainly comprised of about 21,000 meters of reverse circulation drilling and just over 1,000 meters of diamond drilling. And why that weight is like that is that the previous year it was about 50-50 of diamond drilling versus reverse circulation. We now have, we feel, enough information on the geology to actually put the weight of the drilling into reverse circulation. The targets are Motapa North, and it's predominantly to define a sulfide resource below historical oxide pits. There's about 16,000 meters of drilling there in total. A second target is Mapudzi. The intention there is to have a look at predominantly the oxides going into the upper sulfides. And why this is the case is simply at Mapudzi, there's no historical open pits on site. So we do believe that if all the work is done and it is amenable to heap leaching, that the potential is there to define an oxide mineral resource that can come onto our books in the near future. A little bit of further exploration at Motapa South. And to date, we have drilled about 50% of our budget. We're just under 10,000 meters. All of this drilling will be updated once we have sufficient assays coming in. So although we've drilled about 50% of our budget, from the assays that we've submitted to the local labs, the Zimbabwe labs, accredited labs, we've only received about 40% of those assays back. And so, I mean, it's very frustrating for us, but in kind of a Zimbabwean context, it's actually very encouraging. The reason for the slow turnaround is it's not just us that are submitting hundreds of samples. There's a number of other companies that are on the scene and quite clearly in this higher gold price environment have pulled the trigger on exploration, which I think bodes well for Zimbabwe. I think it's completely underexplored, maybe not well understood, but there's significant potential for the country. If we can just go on to the next slide, it's just a brief overview of Motapa North. It's made up of those open pits that you see, the Pluvius pits, the Boomgate, Jupiter, and Shawl. The blue line boundary, or the blue line that you see there, is the Bilboes property to the north. It's about 200 meters away. All the red dots is all of the first pass drilling we did during 2024, and all of the yellow dots represent the drilling that we have done and completed to date. So there'll be about 50% more of those dots. The targeted aim here, and so as I said, so as we receive the assays in and we have a bulk of results that we can release, we will put out an update. But the main goal is by year end, we want to have defined a sulfide mineral resource that we can declare, and we can move into quite probably a study phase. If we go on to the next slide, which just shows the Mapudzi area. So the picture's a bit blurry. The Google Earth is not very good on that imagery. But you can see there's no open pit mines or open pit holes. Once again, all of the red is what was the first pass drilling in 2024, a bit of wider space drilling. All of the yellow is what we've done to date. And Mapudzi is slightly different to the other Motapa areas because it's focused mainly on a banded iron formation. It's got a bit of shearing. We're getting some good grades, we're getting some good widths, but we'll update the market on that as we go forward. So with that, I'll hand back over to Mark for any closing comments.
Good, thank you, Craig. Should we just move to the last page? Okay. So in terms of outlook, the objective of Blanket is to achieve the target range of 75,500 to just under 80,000 ounces. Keep doing the investment to modernize and update the mine, with an increasing focus on cost containment and eventually cost reduction. continue with the investment at Blanket to do, as Craig outlined, depletion replacement, but also looking at Blanket at potential for near-term revenue opportunities. We'll continue looking at continue the work on the feasibility study at Bilboes, looking at ways to look. The project's a great project, just looking at ways to make it better. And typically in Zim, we've always had to battle against bad things that have caught us sort of unexpectedly. I think in this situation, we're actually trying to make the best of good things. So build on good things that are happening for the benefit of investors. But then clearly, as Craig outlined, continue exploring at Motapa, looking at oxides and sulfides. So, you know, there's a lot happening. And I've got to say, these results give a very, very nice sort of launching pad for further activity. So thank you all for joining us today. It's been a good performance from the entire team, and I thank them for that. And we look forward to doing it all again in mid-November. So thank you very much.